Thank you, David and Connor. It's good to see that there's a lot of board members on the call, especially when the large percentage of you are managed by professional management firms. Staying educated on especially banking matters and your your finances, and if you've got somebody else, a third party handling it, it's good to keep up and knowledgeable on what's available out there. Okay. I'm kind of worried for the person who, where was that they don't have a manager, they're not self-managed, and they don't have anybody reconciling anything. So I'm really worried about you. Hopefully you're not a board member and you're just a homeowner in an association, because we have some of those, and that's good to keep educated, but you're just not involved in the financial part of it. So good poll. I just want to make a comment that my deck here is kind of focused on the self-managed association. So there are aspects that you'll see of services and tools that your management company is leveraging in order to keep your money safe and to be efficient and streamline processes. So there may be some things that I cover today that wouldn't be something that you as a managed association would use those services, but at least you know what your management companies are leveraging in order to do a good job for you. Okay, so Connor, can you go to the next page? So the first thing I want to talk about is I'm hoping that everybody on the phone here is using an HOA friendly bank. HOA banking is very operational intensive. There's a lot of moving parts because there's a lot of different services and products that you or your management company is using to make banking easier for you, and they know the HOA industry, and so they have best practices, and they can counsel you on oversight and the controls and the triggers that are important for you to watch for in managing your association funds. There is a fiduciary responsibility as a board member, and so you want to make sure that you are keeping the money safe and secure for all your homeowners, because the funds in those accounts are to maintain the property and ensure that everybody's property maintains value, right? So let's go to the next slide. And so let me kind of talk about what I mean by an HOA friendly bank. Okay, usually a bank that focuses on HOA specialty banking, whether it's a large institution or a regional, have a division or have specialists. Okay, there's a department or division that handles the program. Okay, and the program has should have three major areas. Having to do with collecting of your dues, helping with your payables, investing those excess reserves or idle reserves, and loans for any kind of maintenance that you have. So if you're with a bank that doesn't have a program, then I would suggest strongly you find one. The people at these banks have a deep knowledge of not only the operations of all the treasury services and the bank accounts and how the financing goes with an association, but they're up to speed on the industry, what is happening. There's many vendors that specialize in this industry, and they would have access and would be your resource if you're looking to expand or looking for a resource that really focuses on your industry. Okay. And because there are so many different moving parts to HOA banking, they leverage all the services that will help you streamline, or your management company streamline all the financial services surrounding an association. So let's start on the next slide with why. Okay, why do you need an HOA friendly bank? Uh, besides the fact that they have a division, besides the fact that they have the specialists that know the industry, but they're going to have special accounts, special deposit accounts, and they're going to focus on achieving you some good yields. Although, as we all know, the environment, the interest environment today is in the toilet, and the rates are super low. But that is one of the focuses on these specialty deposit accounts, giving you good yields, because we know that the interest income is a good part of the income for your nonprofit association. Okay. And then most of the banks that are HOA banks have bundled all the treasury services that streamline the processing. They bundle it so that there are either low or no bank fees to associations, because if you look at the programs below in the second bullet point, not the streamlined processes that like signature cards. You have one signature card and enrollment form for all the different services, but you can see that the treasury services involved in association banking include lockbox, collecting of those dues. If you've got dues coming into somebody's being mailed to a treasurer, getting those deposits, those dues into the bank through mobile banking or online banking or remote deposit, using bill pay to generate and pay your vendors electronically, okay? And then all the reporting that comes along if you lose lockbox services, so that you can see who's paid, see the check, see the images, and reconcile. That's a lot of different services that, corporates that use those kind of services, they're extremely expensive. But the banks that are HOA friendly, because they've got a division and because the volume of people using these services, they're able to provide the services at little or no charge. Okay. And then collection services. We try to think of every way possible to help you collect your dues. Okay, so usually the HOA friendly bank will have a portal that homeowners can go and make their payments either by e-check, by credit card, by debit card. Okay, and so it's quite extensive, the services that are available to your association to collect dues. Again, the single department focuses the staff so that they're focused on all the different services that we can provide you. And then with those services, it's much more efficient, and the ease of banking through all the different treasury services puts it all at your fingertips to bank with ease. The next slide. So I want to talk a little bit about bank accounts, because as we know, well, you all know that your board could change every year. And that makes for an operational nightmare when you're trying to keep your signature cards up to date. Okay. And to one of the questions of that 100-unit, the 100-unit property that has 4 or 5 banks, running around town to get a signature card updated for the 4 or 5 banks, you'll see later in the presentation where an HOA friendly bank, you'll have one signature card that can take care of everything for you. Okay, we'll talk about that in a minute. But it's because your board can change every year, it's super important that you all keep your signature cards up to date. Okay. It could delay access to your funds. It could be if you've got, 5 CDs all over town and you don't happen to update a signature card at one of those where a certificate of deposit is maturing, you're going to have a heck of a time, getting those funds out if you need them, and the certificate could renew while you're trying to update the signature card. Okay. And then any kind of special, if you need to run into a branch to get a cashier's check, and you know, and your signature card is not up to date, that will cause issues, okay, for access to your funds. So most HOA banks will have one set of documents, one signature card for all the different services, and they'll make it easy for you to update on an annual basis. Or if you're uh, if your board members are all over town, they can't get into a branch, most HOA banks don't require that. Through the technology we leverage, through DocuSign or secure email or some sort, we will get all the documentation out to you. And then you guys don't even have to leave your houses, and you can take care of signing everything and getting it back. So we're real focused, because we know this part of the operational aspect of finances can change year to year, that we try to make it as easy as possible for you. Okay. Next slide. I just wanted to kind of go through beneficial ownership. That is a new recent law a couple of years ago, and the government has dictated to banks to identify beneficial ownership. So the rule in summary is there's two points. There's the ownership and there's the control. As nonprofit corporations, you don't have to worry about the ownership piece of it, because your board of directors, there's no single ownership. But in terms of a control, to comply with the control aspect of it, banks have to identify a control person. And the control person has to be somebody with authority, usually a board member. So a board member has to be identified as the control person. Cannot be a management company. There's a lot of misunderstanding about this subject. So when the government is talking about the person with control, or creating or identifying a control person, it can't be an agent who you've hired to manage your funds. It's talking about who is a control person for the entity in itself, and that would be a board member. So I just kind of wanted to trying to educate everybody about this aspect of beneficial ownership, because it's been a big deal in the last 3 years or so. So next slide. So as I was telling you, we sit around thinking of ways we can help you collect your dues. So here's a few. Most of HOA banks have, like I said, a payment portal that can collect dues by e-check. They can set it up reoccurring or one-time payment. Lockbox service is a very important collection tool. And even if you're self-managed, you don't have to be managed to leverage this tool. If you're a self-managed association, your HOA bank can set you up on Lockbox. It's best that one of the best practices is really to allow a third party to collect all the payments. Now, if you can collect them all your dues in an electronic manner and send all your homeowners to the payment portal, then you don't have to take possession of any kind of payment. So they'll go directly to the bank. So through the payment portal, through the Lockbox services, your homeowners can pay through their online banking bill pay and send that to the Lockbox. But the key is to get the money into the bank as quickly as possible. And so as a treasurer, so you don't have the responsibility of, people dropping off checks and getting those to the bank, especially now when many of us are working remotely. Having those payments go directly to the bank is really the best course of action. And an HOA bank, Lockbox services are not just for large corporates because of the fees. HOA banks provide Lockbox services to self-managed associations, and generally it doesn't cost anything, okay? And one of the things with the lockbox service is you can log in and keep track of the payments coming in. Okay, and you can get reports. You don't have to wait a month late when you get your bank statement. So one of the best practices is to, and especially in the first 10 days of the month, to kind of monitor the reports and see what kind of payments have come in.
Teresa, can you define what lockbox means exactly?
Good
we
point. Some of us bankers, we don't, I'm sorry. Yes, thank you. So your association will give you a PO box. You would give the PO box, and that's owned by the bank, comes to the bank. So members can mail a check. When they go into their online banking bill pay and they set up to pay their vendor or pay their dues, they would put in that PO box. Much like a PG&E bill, there's a PO box that you remit your payment to. Same thing, except you would own your own PO box with the bank, and the bank would assign that to you. You'd get that out to everybody. So let's talk about payables. Payables when you have to pay all your vendors. Okay, even if you're a self-managed association, there are software packages out there, Quicken, that are very, very inexpensive that you can use. And one of the things that we've all moved to, and that we highly suggest that you move to, is get rid of check stock. So most softwares can issue a check off of blank paper. Okay, the old days of having your bank print a bunch of checks and you have boxes of checks laying around the office, that's a risk. And so so you want to really look at the software that you're using. Management, if you're a managed association like many of you are, your management company has leveraged top-notch software these days. It's all about integration. It's all about software and getting away. I don't think I know any management company that has actual check stock lying around, which is good for you as board members, because check stock lying around is just open for fraud. And so if you're a self-managed association, there is software. If you don't want to buy the software, then you should leverage your bank's bill pay service. Again, you don't have check stock lying around, and you're paying it out, and it's more efficient, it's faster, and it's safer. The one best practice that I would suggest, though, is if you're a self-managed association and you're using the bill pay service, that you do it in dual control. Not any one board member wants a responsibility of access to the association funds. You've got to have your checks and balances. That money is important to the association, and the responsibility of just one person having access to it is certainly kind of scary. So it's two eyes are better than one. Separation of duties is important. And we didn't cover it back when you were cutting checks, but if you're writing checks and signing checks, especially on reserve accounts, you should have dual signatures. So you got two people who withdraw. Most of your money is sitting in your reserve funds. And the best practice is to have two people sign on reserve checks before you make any disbursements. So if you're using technology like bill pay services, commercial bill pay services has dual control, where it takes one person, one user, to create a check, and then a second user to approve the check before it's dispersed and withdrawn from your bank account. So, and these are all through online banking systems. They're all web-based, so it's not like you have to be together to do it. It's just separation of duties. You can do it from the convenience of your own home in front of your computer.
Teresa, there was a good question from Stephen on this. and I think you answered it, was what multiple direct touch requirements can be implemented with bill pay, so directors are required to be involved in releasing the money. And I think you've touched base on that through
Yes.
technology. If you want to just reiterate.
Yes,
for
and
him.
I think that if you're a self-managed association, the bill pay service is probably the best for you. You know, don't order checks, so you have check orders in paper stock sitting in somebody's, closet. If you use bill pay service, it's all online. Don't order checks, okay? And then you set up in the bill pay dual control. So you'd be setting up multiple users, and then it would always take two people to disperse funds. And you can do this both on your reserve and operating account, but I would highly suggest or recommend that you at least do it on your reserve funds, because that is where the majority of your money is.
There was a question on, somebody had, our management company does the signatures. Is that a good idea? If you can touch base, in some cases, there are managers that are the sole signers on the operating account versus the board on the reserve. If you could touch base on that and how that works.
When in a managed association, your management company should not be signing on your reserve account. That should take board disbursement authority or approval. So there's many cases that management companies sign on operating accounts just to keep operations going, and so there's no delay. But on the reserve accounts, it should take board, and usually two board members approval to make disbursements from reserve accounts.
And one of the reasons, I was going to say, one of the reasons why some management companies sign on the operating account is that it's based on the budget, and the budget was approved, and these monthly payments are the same every month. If there are some unique or extra expenditures, usually they will obviously would get the approval of the board to make those. Usually that happens in landscaping. If they're doing extra work, that is still part of the budget. And that's why we see some management companies that just sign on the operating payables.
Yes. Thank you, Chris. That's great. Next slide. So I want to run through, and I don't mean this to scare anybody, but I just want to run through some fraud alerts and best practices, especially with the pandemic. We have seen, banks in general have seen a real increase in fraud. And so some best practices, if you actually do have check stock sitting around and it gets stolen, then you really need to close that account. And I understand how complicated that is sometimes if you've got automatic payments coming out and such. But the only way that you can be 1000% sure that no one will get access to your account, you need to close that and open a new account. Okay. Any outstanding checks that are more than 45 to 60 days, you need to place a stop payment. They're obviously lost, and you don't want to take any chances. And then reissue it. If you're on the board and you have a manager, when you're reviewing the financials and the outstanding items, that should be something that you look at. Take a look and see if there's any stale checks that are out there more than 60 days, and then have your management company place a stop payment on those and reissue them.
Teresa, can I
yes.
Comment on the stop payments? This just came up just recently. It is important that stop payments usually are for 6 months only, and you should renew it the 6 months, because all banks, they can't look at every single check that comes in. And we have seen some checks be presented that are a year old. And of course, as a friendly HOA banker, we're on it, and we contact either the board members or the management company to see if the check is good. But it is important to note that there is a maturity on that stop payment, and you should at least renew it for another 6 months just in case it comes up.
Yeah, good point. If you do actually have, you're writing checks and not using electronic means, the number one fraud that we see around, check fraud is check they call it check washing, where the payee and the amount is or the amount is changed. Okay, so just monitor your account frequently. I'm sure everybody has, if you're self-managed, you should have online banking and you should be monitoring at least, well, monthly, you should be reconciling. But if you've got a lot of activity, if you're a larger association and you do have a lot of activity, then, jumping on online banking and just taking a quick peruse once a week is probably a good idea.
Teresa, there was a couple of questions earlier about this one issue of some board members not having access to the online banking account. So maybe we could show or describe as an HOA friendly bank how they can get that access and how important it is for at least one of them, because some asked, should all the entire board have access to the accounts, or would it take one or two maybe to view it online?
I'll answer that in two ways. It depends, if you have a professional manager, for instance, you're paying them to take care of that, and they're monitoring things on a daily basis, I can tell you. And you should be on your monthly meetings with your management company. They should be providing you all kinds of financial information, bank statements, reconciling information. And so, the need for you to have access to online banking may not be as much, okay? But at HOA Friendly Banks, if you're a treasurer and you are managed and you want access to online banking to view, that is available at your HOA Friendly Bank, okay? Now, if you're a self-managed association, then you definitely should have online banking, and you can have as many users as you want. So depending on the makeup of your board and how involved your board is in the finances, but definitely the people who are working with the finances on a daily basis, they should have access. And there's no maximum or limit of the number of users that can be set up. They should be an authorized person on the bank accounts. It would be the best practice, but there is no limit. So if the whole board wants access, great. What you do need to do, however, when the signature card has to be updated because a board member leaves or is changed, you need to make sure that you don't forget to go into online banking and turn off that access. So we've had lots of situations where people are on the board for a couple of years, then they leave the board, and then people forget to, because you have admin rights to set up users, you forget to take them off of online banking, and so now they can see everything. Now, if you don't care about that, no problem, but best practice is that they should be removed when you update the signature card. Okay, next slide. So a couple more slides of just fraud alerts. Email compromise is probably the #1 corporate fraud that we're seeing these days, especially with the pandemic. Email compromise is when somebody gets into your system and they can read all your emails, and they can actually initiate emails as if they were coming from you. So I'm going to say, don't ever put any account information or tax ID information or any information that you would normally give your bank to open an account. You don't want to put that stuff in an email unless it's secure, obviously, to your banker, because people who are compromising others' emails, the fraudsters can find that information and they can do terrible things. We've had the corporates where somebody will send an email on behalf of Teresa Powell, giving them authority to move money to, an account or wire money out And so the person receiving the email thinks that it's a legitimate email. They go and write a check or send an ACH or send a wire. And by the time they find out that it didn't really come from Teresa Powell, the money is gone. So just be cognizant about emails. I'm sure everybody uses emails and for work, and so you know the security all around email. So just be cognizant that you don't put any private information about the association account in any emails. Okay, and then altered amounts is another item that has come up. And I think the next slide is the last one. Make sure you have internal controls. You know, I see a lot of, Stephen brought up a couple of questions about controls. It's important, especially if you're a self-managed association, that you have separation of duties, okay? Make sure that the people who are doing funds transfers, who they're authorized, okay? Especially money coming out of reserve into operating accounts, okay? And then lastly, I'm gonna beat this one to death. Hey, if you can get away from having pre-printed checks in boxes somewhere, do it, okay? Next slide. There are services, and I'm sure that those of you who are managed, your management companies are leveraging these services like positive pay and ACH blocking. What that means is there are systems that every time they do a vendor cut of checks and pay vendors, they let the bank through the online system know. And then every check that comes through on the bank account to be paid, it's matched against that listing. And if anything doesn't match, then it hits an exception. The same with ACH or automatic debits to the account, okay? So this is a way that your management company is making sure on a daily basis that everything that comes through to your bank account is supposed to hit your bank account, okay? If you're self-managed, you can look into these services and see if it's cost effective. But if you're self-managed and you don't have a huge volumes of checks coming in, then the weekly monitoring is probably sufficient for you, as long as somebody is monitoring the activity in the account that's hitting your account, especially with so much electronic banking now and ACH influx. Okay. Next slide. I've been looking at all these Q&As, and there's been a lot of questions about investments, and I call them excess reserves. You can call them idle reserves. I do want to spend a little bit of time on this subject, okay? As a board member, it's your fiduciary responsibility to make sure that the money is all safe, okay? That it's FDIC insured, or SIPC with credit unions. But the coverage is $250,000, okay? So you need to make sure that you're cognizant about what your operating run rate is. So how much money you need to keep in your operating account on a monthly basis. Then you'll have I'm going to call liquid reserve, like a reserve account. And you need to make sure that has your, I'm going to say a 6 month to 8 month run rate. But you need to make sure that those liquid monies that are in the bank don't exceed $250,000, okay? Anything over $250,000 between those two accounts, you'll want to place in CDs or other kind of investments that are FDIC insured, okay? If you go to the next slide.
And Teresa, can you just reiterate for the group, because this question comes up all the time. People think it's $250 per account, and can you just confirm on the tax ID an example of that?
Yes. It is not per account, it's per tax ID number. So that's why I say in your primary and liquid monies, your operating and your reserve account, you need to look at both those accounts to make sure that between the two of them, that there's no more than $250,000 in one bank. Okay. Now, those of you like the one that I saw in one of the questions and answers that had four banks. Well, it's because you're probably running around town, spreading the money around so that it's all FDIC insured. The great news is your HOA banks, okay, it doesn't sound like you're with an HOA bank. Okay, if you're with an HOA friendly bank, they have placement services. Okay, and what that means is they have either a liquid, which is a sweep, or you can put it into a certificate of deposits. Now, because rates are so low, you have to go out pretty far to get any kind of a decent rate to beat the rate that you can get in a money market or a liquid account. So why do that? Okay, well, the HOA bank will have both those options for you and have it all FDIC insured. So what that means is you fill out one signature card, one placement agreement, then you're done. You can set a threshold on your accounts that are in the bank, and anything else will sweep out into a placement service, and they will make sure that all of that money is FDIC insured. Okay. If you want to put it into a CD, you can just move the money from the reserve account, give instructions, pick a term, and your HOA bank can place it in a CD into the network, and it will be FDIC insured. By being in their program, you can make sure that all of your money, whether it's in the bank, whether it's in the CD, or whether it's in a sweep, like a liquid money market, that is all FDIC insured. And you can do it with one set of documents, one signature card that you have to update annually when your board changes. Okay. It's streamlined because you get one monthly statement that shows all your investments. And at the end of the year, you get one 1099 of all the interest that you earned. All $10.45 this last year. We're so bad. But the point is, if you're running around town, you don't need to do that with an HOA bank. Now,
There was
I saw a lot of questions about that. So I don't know, Chris, have you been reading? Did I miss anything?
Yeah. No, it's excellent. You know, we like to call it our one-stop shop, so you don't have to run around and you know, sign signature cards that you have to monitor and make sure they're up to date. I think that's the biggest thing that associations go through, is that they forget to update one card at one bank where they have reserves, and then that bank requires that the whole board, you know, come down to a branch and provide all sorts of personal information in order to update a card and get their access to their money. And if they don't touch their money after a number of years and nobody knows where those funds are, those funds could be escheated to the state. So it's really important to be banking with your, you know, friendly HOA banker that has this kind of service, the one-stop shop for all your investment needs. There was a question that came up in the chat about that the management company says that they have a relationship with the bank and that all funds are insured, but they have no proof of it. You know, we provide CD bank statements that show where all the CDs have been placed, what their interest rates are, maturity dates, etc. That's one proof of showing it, which should be in your board packet. Teresa, was there any other maybe comments on that side of how they know it's 100% insured?
Well, you'll want your management company to show you proof. And again, that would be it would be a comprehensive statement that would show if the money is all sitting in CDs and in the placement service, for instance, that we just described. There are some banks that offer you to purchase additional FDIC insurance, leaving all the money in one account. It's not super popular, but there is a service like that. So perhaps your management company is with a bank that does that. If that's the case, you just need to have them show you proof of that. That's the program or service that they're opting in for your balances. But in either case, they should be able to show you proof that it's 100% FDIC insured. And as a board member, you'll want that because, you know, because we all know, if any, you know, we all were around in the 2007, 8, 9 years, banks can fail. And what comes through is the FDIC insurance. So if it's not FDIC insured and a bank fails, unless that bank is acquired by another bank that will honor all the deposits, you could lose the money. And that's kind of a scary thing when it's really not your money to lose. So just make sure that you get proof. Okay.
Teresa, on that reserves, because there's lots of questions on the reserves and how to invest it. Can you just review how important it is to, when they decide on what term, how long to go out, and how they should be reviewing their reserve study to see what reserve expenditures are coming up to help guide them for those investments in those terms?
Right. Well, the reserve study is super important. I know it costs a little bit of money to do, but it's critical that you do a reserve study. That will tell you exactly, you'll be able to map out exactly when you're going to need your money, your reserve money, to fix those items that are going to fail according to the reserve study. And then you have a typically an annual run rate of reserve funds that you're going to need for maintenance. So that's easy, that's budgeted for. But the reserve study for those large expenditures, you'll want to look at your reserve study, and then you can ladder your reserves out, okay, to make sure that you get the most yield on those idle reserve funds over time, because this is why HOA banks love you, okay, because you have reserve monies that are just idle and sitting there. So if anyone tells you that you're not an extremely valued customer to any bank, they're lying to you. You are very valuable to banks, okay? Now, an HOA bank really understands it, so you want to stick with one of them. And HOA banks have a division, like I was telling you, and people and consultants. We are consultants. We will help you. We can look at your reserve study and see kind of with you and plan out. We can ladder your reserve money to make sure that, one, it will be available when you need it, and two, you'll get the best yields possible and interest income from those idle reserves until you need the money. So use your bank, use your banker, and they're consultants, and they will help you. Okay.
Can you brush on you know, the differences in using an HOA friendly bank in investments versus like a brokerage firm, and the differences and what to look out for on the brokerage firm pertaining to fees?
Yeah. Well, the brokerage firms, that's an option. Some brokerage firms do have placement services. But I find that some brokerage firms, they do have fees associated with the investment. So you need to make sure that there's no hidden fees there. I can tell you, if you're with an HOA bank and you're using FDIC insured instruments for your money, that the HOA banks do not charge a fee for placement services, okay? But brokerage fees, there are brokerage fees. So you just need to watch out for that. Okay.
There was a question on what percentage does the bank keep on that, and I'm always kind of laugh at that because, you know, as you know, all banks and brokerage firms, we're here, you know, to make a profit. So obviously, there would be a slight, you know, percentage in there for the bank, right?
Well, the difference between like a bank's placement fee services and like a brokerage house is that when an HOA bank tells you what your rate's going to be on a placement service, that is net of, I'm going to say, their cut in the rate. there are no fees for the service, okay? So brokerage firms do have placement services, and they have liquid investments, and then they quote you a rate, but then they have fees on top of that. So there's a difference between fees, and then I'm going to say banks that have a margin, if you will, on the interest rate. So you just need to make sure that when you're quoted an interest rate, you want to make sure that that's net. That is actual interest rate you're going to be earning. Okay. And then the next question you should ask is, if this is my rate that I expect to earn interest, then are there any fees for the service, or for placing, or per transaction, if that makes sense? Okay.
And that's really important because it's on the brokerage fee. Sometimes it's 150 to 300 annual fee, which is going to basically wash out a lot of interest income that you could potentially make. So it is important to review that and to make sure you are getting what you're getting, and there's no.
That's exactly right. That's the right way to look at it. Okay, don't just hear the rate. Okay, ask the questions and then do your calculation, because that interest rate, if there's fees, is going to affect really the realized interest rate that you're earning. So, if that makes sense. So let's go to the next slide. I don't know if we're running out of time, but I don't want to. Loans. So I wanted to touch on loans.
Teresa, let me just tell you, we're at about 55 minutes in, so we're not running out of time. I don't know how many slides you have left, but that's just a marker. So we're doing okay.
Okay, good. We'll keep the questions coming in terms of, just general questions, because I think we'll have a Q&A after we're done going through the deck, that we can go back and touch on anything. But I wanted to get through the deck because I do see a couple of questions about loans. So HOA loans, that was the other component of a program that an HOA bank will have. And a couple of things that are important to note, and California has, I don't know, something like 47,000 associations that are, and high percentage of those are over 30 years old. There's probably a lot of deferred maintenance. People have not been doing anything since the pandemic hit. So there's going to be maintenance needs. Okay. And the question you need to ask is, when you look at your reserve account, okay, you're going to have enough money for that. And this is where a loan may help. Now, a couple of structural things that you need to know is the HOA loans are unsecured loans, meaning they're not going to take property. Okay, so your homeowners are not going to have to put up their house. There's no real estate, and I'm telling you, no bank wants your community area. Okay, so these are considered unsecured commercial loans. Okay, what they allow you to do is, instead of saving up the reserves over time for that project, it allows you to get the project done sooner than later. It also, if there's going to be a special assessment involved, okay, it allows that the homeowners that can't cough up $40,000 for a special assessment, that you can give them terms. So the loan is made to the association. Okay, the association, if you've got members that cannot write a check for 40 grand for the special assessment, you can give them time. They can pay that 40,000 over time. Generally, you want to mirror the term of the loan to the term of the pay over time that you give to your homeowner. Okay, so it allows those people who can't go out and get an equity loan, or don't have the cash to pay over time, and you don't have to worry about delinquencies on people who can't write that check. The payment the repayment stream that banks look at are regular assessments, any kind of special assessment, and then we always want a secondary source of repayment, which is the reserves that are sitting there. Okay. So because those are the three payment streams that banks are going to look at when approving your association for a loan, one, you don't want to use up all your reserves, find out that you're out of money, and try to go get a bank loan. You will not qualify. Okay. Your consultant, I'm going to call them consultants, because at HOA banks that have HOA bankers, they are there to help you. There's many ways, and we've been very creative in the last 5 years at helping associations figure out how they're going to do a project. And you don't always have to do a one-to-one relationship between doing a special, I need $1 million, so I'm going to do a special assessment of $1 million. You may have a combination of your existing dues, or maybe you increase your dues a little, combination with a smaller special assessment, because you may have a boatload of money in your reserve account. So between the three, your HOA banker can help you and consult with you to figure out what the best structure in the mix, and give you options. Well, think of it this way, think of it that way, and they can run the numbers to let you know what your association would qualify, if that makes sense. So it's not always, oh gosh, we have this huge project, we need to special assess, and then we need to, and that's it. Or we need to special assess, now we need a bank loan so we can do it now. We don't have to wait until we collect all those special assessments. And we can give people longer period of time to pay that special assessment, but get the work done now. Because as you know, and probably if you've talked to any kind of vendors out there, a roof today is going to be a lot cheaper to replace than a roof in 2 years or 3 years or 10 years. So anyway, so an HOA loan may be a viable solution for you, but you won't know until you sit down with your HOA banker and kind of analyze the situation and then make a decision. Your HOA banker will sit down with your board, present a couple of options, and you can do some pre-work to really decide if it's the best way to go. And I think that's all I have to say, because I think the next slide is questions.
I was going to just comment on the loans, because everybody's been reviewing the bills coming up, and the one SB 326, which is known as the balcony bill, but it is also reviewing all of the infrastructure that is load bearing for associations. And by 2025, associations need to do a certain amount of inspections of those load-bearing type walls. So like in a condominium association, typically you're going to have stairwells or stairs, and maybe catwalks and other load-bearing things like balconies. And the big thing that we've noticed in this last year is that all items have gone up tremendously. Lumber, insurance premiums, electrical and plumbing, and associations components are much older now in some of the associations. They're not new. And associations are having to deal with things like, replacing elevators and replacing boilers and replacing things that are not even on the 30-year reserve study. And so between this one bill where you do need to have some inspections, which is going to cost a lot of money, now's the time to plan for that and look at your reserve study, see if you do need to increase your assessments every year to meet that need, and or start looking to see if you might need a loan to help subsidize that.
Yeah, those are for elevated structures, condominiums only. And so you really need to start looking at that. There's 2 phases to that too. And I think that trips up people every once in a while. It's only elevated structures, which means stairwells and balconies and some other, small catwalks and things like that. that are supported by wood. And so if they're not supported by wood, if it's steel supported, you're good. Otherwise, you better have somebody out there pretty soon. I think they all have to be done in the next year or two, the inspections. The inspection cost itself is causing some of the associations that I've spoken with to actually do special assessments, just the inspection. If it goes beyond the inspection and they find that there is a problem, then you run in, and then it's a major issue, and you're going to look at some fairly significant cost. That's going to be a major capital improvement. So pay attention to that one. That's a great suggestion. The banks do have some really good, especially those that understand this, the HOA banks, they understand this and they understand the law. It's a great one to take a look at. I'm glad you mentioned the elevators, Chris. Sometimes we just don't have control over the legislature. In this case, the County of San Francisco put in some new elevator codes that you had to, do some research on, or excuse me, you had to double check that. So that's a problem, because if they find something, you got to go get it fixed, and that's it's always a challenge to. We can't really control what happens there. Of course, the positive side is that you're going to have a very safe, a much safer community. So we definitely don't want to pitch it too bad that way, but banks are there to help you. So why don't we go into the Q&A session here? We've already been asking and answering a lot of these questions. I want to say, tell everyone or remind everyone to go to the Q&A section. Make sure you're putting your questions in the Q&A section. Put a thumbs up. There's, just click on the little thumbs up there if you want your question asked, and then we are sorting by that thumbs up. So we'll go to those questions first and then start answering those questions. So Chris, I'm going to ask you to take a look too, so that you've been answering some of these, and Teresa, you get to start and answer the questions. So we'll go ahead and get rolling here. The number one here is, how much money should we have in our reserves before investing?
Well, I think what you need to do is figure out in a 1 year period, what is your typical maintenance cost that you would be using reserve funds based on your budget and based on your reserve study. Typically, okay, everything else can be invested, but I go back to the reserve study, that those years that you're going to have repairs on some, major, element of your property, that obviously then you need to evaluate what you're going to need for that year and start looking at your investments as they come due and bring money back, either in a liquid FDIC insured account with these placement services, or ladder them when they come up for renewal, ladder them so the money will come due when you need it for those repairs on those elements that year. So it should be something that looks at year to year. When you're doing your budgeting, that's a good time to look at the next year and say, okay, what do we have coming up according to our reserve study? And, what are our normal budgeted reserve expenditures that we have for maintenance for the following year?
And maybe you can just explain what you mean by laddering. I think that's
oh, okay, sorry. So if you've got $100,000 and you're going to need to put in some fencing in the first quarter, and you need 50 grand, then you'll want it when that $100,000, when you're ready to renew that CD, because that came up for maturity, right? You got $100,000 to invest. Then put in 50,000 into a CD that's going to come due in 2 months, so that it's ready for you. And then put the other 50,000 in a 6 month or 7 month or whatever that gives you the best yield, because you won't need that. So when I say ladder, look at your expenditures for the next year, when you're going to need the money. Then as your CDs mature, make sure that you've got money coming due when you need it for those expenditures.
Right. Yeah, that's a good question. It's all about budgeting, right? So that's a good question. So Chris, do you have anything you want to, any of these questions? Here's one. A multi-director touch requirement can be implemented with bill pay. So directors are required to be involved in releasing the money. I don't know what the question is, but
Yeah,
what?
we did touch base on that a little bit, having dual custody. I think Teresa did cover that, but if you want to reiterate it,
Yeah,
Teresa?
so I think I think that was Stephen, right? So what he's asking is,
Mhm.
if you're going to use bill pay, which is an online service through online banking that the association could pay bills, okay? Now we're not even see people writing checks. I'm not going to see it in the board meeting. How do I know that people aren't just paying their own bills? So what you want to do is, if you sign up for the bill pay service, it's going to be a business bill pay product, which allows for dual control, meaning when you set up the users who are going to be using the bill pay service, you set one person up, you set it up so that not one person can actually release a payment. So it would take one user to set up the payment and then a second user to approve that payment before it's made. That's a good question. A lot of people and a lot of self-managed associations use bill pay because of the ease of it, but they forget to put in the controls, because when you're writing physical checks, then you have to walk over, bring them to a board meeting, and somebody else has to co-sign it, right? And you're using a physical thing. If you move to an electronic payment method like bill pay, then now, somebody's at home, paying bills. You can't forget that oversight. So that's where you have the two users.
Yeah, this is interesting because do you recommend that the entire board have access to the account activity, the board?
It depends. I would say the people who are involved in the whole board, because there's not a maximum. You can have as many users as you want, but you have to remember that you're going to be managing those users, right? So if a board member leaves, you need to make sure that you turn them off. But through online banking, that's where the bill pay is, and that's where you want to give entitlements to the different users to do different things. So if you want oversight, so you have the three board members that aren't involved in the finance side of it, give them view access so they can see what's going on. But then the people who are doing the financial work, like paying bills, then you set those two users up on bill pay where it takes both of them to release money.
Yeah, and Vicky asked the question, it's important that there be transparency, especially when you have the fiduciary, which is a legal requirement to protect the funds of the association. You have that fiduciary responsibility, and if you cannot see the records, then how do you exercise that oversight? You need to have that access. If your current board does not have access, then that's something you need to fix, and fix it pretty quickly. That's a big red flag in my book, to make sure that you do have are at least able to see what the records are. And if you're transferring funds out of a reserve, you also need to make sure that the boards are approving the transfer of a certain level of fund. There's a new law that's passed, I think it's $10,000. So, or a percentage of the total amount of the reserve. So that's another way to protect against fraud or embezzlement and things like that. But definitely get access to those records, or you don't have to have the touch, actually writing checks and have that authority, but to see what's going on is really important.
Right, and I was going to add on to that. So those of you who are self-managed, then obviously transparency to the rest of the board, if only the financial people are using tools like bill pay and online banking. If you're a managed association, then your board meetings better include transparency to everything that happened in the financial world by the management company. So that's what we mean by transparency. So if you're a managed association, you've hired an agent to take care of all this for you. You don't need to see day to day what they're doing, just set up some best practices that an oversight that you're comfortable with. But on that monthly board meeting, you be sure that everything is transparent to you with the reporting that comes from the management company.
And then one of the tips David Levy gives us is to make sure who's a CPA and does HOA stuff is he says, make sure that you're getting those reconciliations, that those checks are balancing. always do that. It's an important step. Okay, so onward. Our management company still authorizes work to be done in homeowner units that are homeowner responsibility, but bills it to the Twin Pines to pay it. And when do we charge back on the invoice? He gets very upset and doesn't want to honor our credit card and our CC&Rs. This is why we sign our operating checks. How is there a proper way to go about this, please? And 3 people thumbs up. Is that clear enough to you? It wasn't clear to me.
No, not really clear.
Okay, do you see that in the question box there? Our management company
Right.
still authorizes the work. So the management company is authorizing the work. They're doing the work, and then they're paying for the work to be done, but he's not telling the going back to the board to get it authorized. And so there's this lack of oversight, I guess it is, and he won't give them the access before he writes those operating checks.
Okay.
But I think Teresa, to get you off the hook here, that's a process issue. If you don't feel that you're able to exercise your fiduciary responsibility, of course, we don't know your specifics in that case, so you can't speak specifically to that. Generally speaking, you're going to want to have access to when those are done, when they're signing the checks. Now, you may have delegated at some point, and maybe even before you were on the board, you may have delegated the authority for the management firm to go ahead and pay up to a certain amount through the budgeting process. And we talked about that earlier. That's a step that you need to do. So you have to really pay attention to or dive into how you've set up the processes in payments and how you do things in your organization.
Yeah, and that has to do with a whole lot more than just, this kind of work. Anytime it's gonna cost the association or monies are gonna flow out of an association account, I firmly believe that, the management company should seek authority approval to do that. Do you know what I mean? So, and as David said, that's a process thing. So it's your level of comfort. I know some boards that, they hire the management company and then, they just don't, there's no oversight. And then there's other boards that hire a management company, but, have tighter processes in place. And there's all kinds of technology in ways that the management company can get approval, so it won't hold up the operational process or hold up their job now available to them that they leverage. So it can accommodate any kind of a level of oversight that the board wants. So it's more about your board and the board comfort level. But in the end, the board, you as board members are responsible for everything that happens to those accounts, and you're going to be held accountable. So given that, then your level of comfort is what needs to drive the process. Right.
And, one of the things I found that to be useful in running lots of businesses is to have authority levels for those checks. So if the check's 250 or less, maybe they have direct authority to spend the money or write the check. But if it goes over 250, they have to get a verbal approval. If it goes over 2,000, you got to get board approval or something like that. That's always a good little policy to have, and it should be in your financial policies. I think we talked a lot about the size of accounts and where to spend money. So there's several of those still in our queue here. We've reached the insurance levels. We talked about how to balance the insurance levels, which is good. Loans against the reserve.
Yeah.
That's a good one to kind of talk about at this point.
There were a couple.
Go ahead, Chris.
I apologize. I saw a few that some associations are small, 22 and under units, that are looking for funding, and maybe just a review on how an association is qualified for a loan, what we're looking for.
Okay.
Sure. Yeah, I saw a couple of points on that because I didn't really talk about the structure of a loan. So usually loans are, there is two parts to an HOA loan, because normally that there's a time frame to actually do the work. So usually a loan will start off with a non-revolving line of credit. So that allows you to get going on the project. You pay the vendors as they finish the work. Okay, so there's no expense on the loan except for interest expense generally during the line of credit, or the draw period is the way we define that. So then there's a draw period, usually 6 to 12 months. If it's a huge project and it's going to take, longer than that, then it can be accommodated as an exception. And so during the draw period, you finish the work. Once you finish the work is complete. Then whatever is outstanding on the line of credit gets flipped into a term loan. And then term loans can be as short as, well, a year, up to like around 10. There's some banks that will go out 15. But the good news is on these HOA loans, they're fixed rates. They're not variable. So it's good for budgeting. You know exactly what your payment's going to be. So the principal and interest starts at the second phase of the loan, which is the term portion. And then it's amortized fully over the term of the loan, the remaining term of the loan. As I said, if it goes out beyond 10 years, then there perhaps is a reset of the rate, because 10 years for a fixed rate is long on an unsecured loan. So hopefully that answers the structural question that I was asked. The other thing is your HOA loans or specialists or consultants can help you. When I was talking about, they can help you structure and, do you need a special assessment or a combination of special assessment and increase in dues? They can kind of brainstorm with you, look at your financial condition or a situation, and then give you a proposal on, based on your situation, what you would qualify for. Okay, how much and whether the association is strong enough to qualify. The key is, like I said, don't start a project, start using up your reserves and go to the bank, when you're out of money, because you won't get the loan. When you're talking about a project, that's when you should talk to. If you think you may need the money, you may run out, or you have members that are not going to be able to write that $50,000 check, that's when you need to engage your HOA consultant. They can do a preliminary review and give you a lot of information that will help you make a decision on which way to go.
Okay, good. Can you just give us an idea how often it is that banks are not providing full FDIC coverage to HOAs? Is there a benchmark?
Well, it's not the banks, it's you as a board member. If you have more than $250,000 in any one bank under your tax ID number, that money is not insured. So you as a board need to do something about that. You either need to put that into a separate bank, a separate CD. When I was talking about CDs and the placement service, your HOA bank is as a service, and they're a member of a network. So if you have more than $250,000, then they can take that extra reserves, put it into the network. The network, that means if that CD is being opened under it in a different bank, not your primary bank, and it will be FDIC insured. So I guess it's not that the bank is not paying insurance. It's the fact that if you have more than $250,000 in any one bank under your tax ID number, it is not FDIC insured, and it's at risk if the bank fails, and if the bank is not acquired by another bank.
Okay, so that's a really, I think, a good answer. One of the key principles there is that it's the board's responsibility to make sure that your funds are FDIC covered, insured, opposed to the bank. It's not the bank's responsibility to know how to manage your money. They give you an instrument.
Now, having said that, we do have the HOA banks have a product that is, it's not a certificate, so you have to pick a term and make all those decisions. If you just are interested in FDIC insurance, it's a liquid service that they can put an automatic sweep on your reserve account. So if it hits a certain dollar amount, it'll automatically sweep into the network, and that will be FDIC insured. And that would, and then, so if you're not sure about where you want to invest it, what the term of the CD and all those things, until you do that, if you set up this, what we call an investment sweep in the placement service, they can set up a threshold and it'll automatically do that. So in that case, you just let it do that. Then when you're ready to actually put it into an investment instrument and made that decision, you can just leave it there. If you need the money, you just write a check off of your reserve account. It'll bring the money back in because it's liquid. So that's a good option for automation.
There was a question of how do you know that the bank offers FDIC insurance? And one thing you know is literally every ad or media type or brochure will always show member FDIC, Federal Deposit Insurance Company. And so really, that's what you look at. And if on brokerage, it's SIPC, it's a similar insurance thing that we have to be members of. I don't know if credit unions or other entities, Teresa, if, I don't know of any other bank that is not a member FDIC. So I'm kind of curious if you ever come across.
I doubt. Yeah, if you find a bank that's not FDIC insured, I would run. Don't even go there. Okay. Now there's different types of insurance, right? The FDIC is Federal Deposit Insurance. Okay, it's backed by the federal government. SPIC, which is brokerage firms, that is private insurance. Okay, that's not government backed. Credit unions are NICU, and those are, that is I think state government. So I just, you just need to keep that in mind as well, right?
Yeah, it's they put that in during I think the bank runs to help protect accounts. So it's really,
yeah.
So here's just a real quick one that we're getting down to the wire. Just a couple minutes left. There's some real quick questions to go by. Somebody here is a little confused on what a CD is and how the bank makes money on the CD. Can you explain how that works? What a CD is and how you make money?
So a certificate, a CD is a certificate of deposit. The only difference between that and a checking account is a certificate of deposit has a maturity, meaning you put it $100,000 in for 1 year. You can't withdraw that money for 1 year, okay, without a penalty for early withdrawal. The basic function of banks and how they make money really are depositors like homeowners associations that have money that they just leave in banks. And then banks take that money and we lend it, okay? The difference between the interest rate that we pay you on the deposit and the interest rate we charge for the loan, that is our margin. Now, there's a lot of other expenses that go into that, like overhead and buildings and systems and blah, blah, blah. But basically, the fundamental way a bank makes money is the difference between interest we pay on deposit accounts or deposits and loans that we make. Now, if we have a bunch of money that is sitting in, 5-year CDs and it's got a term on it, so you as a depositor are penalized if you withdraw early, okay? Banks count on that money for 5 years. And so then they go out and they make 5-year term loans to people, okay? And they know their costs. So we know that if we pay you, 1% on that deposit for 5 years, and then we're going to charge 6% on a loan for 5 years, then we know that we're making 5% on that transaction, that loan transaction. And it's just like with you guys, we know exactly the budget. We know exactly how much we're going to make, and we budget and use that information in planning our profitability. So I don't know if that was too basic or just confused more people, but the basic notion of how banks make money, and that's the basic one. And that's why your business is so important to banks.
Okay, that sounds good. I thought that was a good answer. We have one. This is the last question. Then we got to do the drawing for everybody. So the last question here is, it's a good one. How do you find HOA Friendly Bank?
Well, you can check the ECHO website for their partners. They've got them all listed. And I think you probably have them all listed for the state of California. So I would just refer you to the ECHO website.
Yeah, and then make sure you talk to the bankers, do some interviewing around. That's a good idea. It's in our professional directory online. You can go to our site and find it there. But with that, I think we'll go ahead and close down the questions and answers. Sorry if we didn't get to your question. There were several still remaining. It's always a real challenge to get through all the Q&A. So let's go ahead. Thank you so much to Teresa and Chris for doing this today. My hat's off to you, and we
Our
really
pleasure.
appreciate it. Yeah. So ECHO just released its expanded version of the 2021 statute book and legal directory. It may be purchased from our online store at www.echo-ca.org online store. I recommend that. It contains the updated Davis-Sterling Act and other statutes and case law relevant to HOAs, and a directory of legal professionals specializing in the HOA industry. Thank you for being a member, but if you are not, ECHO holds more than 30 online educational programs per year and offers a vast array of resources for boards and HOA members. If you are not an ECHO member, please consider joining and supporting the oldest statewide association advocating for better communities and well-informed HOA boards and homeowners. To do so, simply visit our website at echo-ca.org and click on the membership tab. This concludes our planned presentation for today.